All right, folks, welcome to Investing for Beginners podcast. Today we have our good friend Brian Feroldi from Long Term Mindset back to join us today. Today we're going to talk about the hidden power of capital allocation and why order matters. So Brian, welcome back to the podcast. Thanks for joining us this morning. And let's talk about some capital allocation.
Thanks, Dave, for having me. It is great to be back. And this is a topic that I think is incredibly important for investors, especially investors in individual businesses, to really understand, because it's something that is confusing at the outset. But once you understand the framework, once you understand the choices that management team has, a whole bunch of things about analyzing businesses becomes just starts to make sense.
Yeah, totally. So I guess let's start with what separates great businesses from averages one. It's not just what they do, it's about what they choose not to do with their cash. So, capital allocation is very important today. There's a lot of conversation about it around AI. So let's talk about how this impacts the CEO capital allocation, and we'll kind of walk through the order of how it works and that. So let's talk about why capital allocation matters. So could you give us maybe a definition of it?
Sure. Capital allocation is simply the process of management allocating the capital that the business has. The capital the business has could be generated generally from two different sources. Source A is internally generated funds, so the profits or the cash flow that the business generates. The management team has to choose, what do we do with the profits that the business is generating? The second source, which is more common for startups and early stage businesses, is capital raised from outside sources. In the beginning, that's typically done from investors in the form of equity. Later stages, it's done from banks in the form of debt. But management teams have full control over the company's capital allocation decisions. And what the companies choose to do with that capital can have an enormous impact on the future value creation of the company. I mean, none other than Warren Buffett believes that the CEO's number one most important job is capital allocation. So it's something that Buffett pays attention to, therefore we should pay attention to it.
Yeah, exactly. So who do you think are some of the really good capital allocators, maybe today and maybe recent past?
There are lots of great capital allocations to choose from, and a very quick short code is to look at market capitalizations. You don't become a multi-trillion-dollar corporation like NVIDIA, like Microsoft, like Apple, without being extremely good, extremely skilled at capital allocation. But beyond that, when I think about really good capital allocation, not at the mega scale, I think of companies like AutoZone or O'Reilly Automotive. These are companies in pretty boring, pretty stable businesses, auto part suppliers, but those companies have generated enormous returns for investors, almost 20% compound annual growth returns, almost sheerly due to capital allocation decisions by the management team. So when used appropriately, capital allocation can be a huge turbocharger to returns and investor returns. And unfortunately, the inverse is also true. When done poorly, you can take a very good business and essentially drive it into the ground.
Yeah, so let's maybe double down on that a little bit. So we all focus on the great capital allocators, but what happens to the poor capital allocators? How does that impact us as investors?
Yeah. So as a business is generating profit, the management team has to choose, again, what do we do with that profit? And as a broad statement, there are 5 general things that they can do with the profit. So let's walk through those. First is reinvest in the core business. So take those profits and replow it back into the business. This could come in tons of different forms. The management team could use that capital to buy new buildings, open up new stores, hire research and development folks. They could re-spend that on marketing, right? There's a lot. They could hire new management teams. They could expand into new international markets, open up new geographies, build new products or services, right? The list of choices within reinvesting in the core business is almost endless. So that's one option that they have. A second option is strengthen the balance sheet. So as the cash is coming in, they could simply increase their cash balance, right? Do nothing with it and build up their cash balance, or they could pay off debt that they have in the business, making the business more resilient. Another option is mergers and acquisitions. They could use the capital to buy out competitors, buy other companies, enter new businesses. A fourth option is give that money directly back to shareholders in the form of a dividend. So just take the cash and pass it right along to shareholders. Some investors love this. And then the fifth and final option would be stock buybacks. So go to the public markets, repurchase your stock, and bring it in and retiring it, thereby reducing the number of shares outstanding. So those are the 5 core options that investors have, and all of them have pros and cons associated with them. So getting them in the right order at the right time, if you do that well, you can really boost your investors' returns. Screw it up, and you could end up going bankrupt if your capital allocation was really that poor.
Right. And I think the thing that we need to remember too is that every dollar that they choose to spend has an opportunity cost, and you only get to spend it once. And so these decisions are very, very, very important. And if a company chooses poorly, if they're like trying to build empires or buying, acquisitions that aren't really necessary for the business, or overpaying for buybacks, which is a really popular thing right now, that can really destroy shareholder value. And I think a lot of people don't really understand how important this really is.
Yeah, a recent example of this that keeps coming to mind is Teladoc and Livongo. During the COVID periods, Teladoc was a go-go growth stock, trading at all-time highs, and at their peak valuation, they bought another publicly traded company called Livongo Health. That was a capital allocation decision on the part of Teladoc's management team. So they almost doubled the size of the business overnight. And when you're trading at a very high valuation, everybody was applauding the idea at the time. But looking back, that has proven to be a disastrous use of capital. The synergies weren't there. The growth slowed down. Teladoc's already bruised balance sheet got even worse. Combining the two companies together just didn't work. And Teladoc Health stock, the last time I looked, was down like over 70% from its peak, perhaps even more. I haven't checked it recently. But to me, that's a prime example of horrible capital allocation decisions by a management team, and what can happen to shareholders if management teams screw this up.
Yeah, exactly. And let's kind of segue into the order. You mentioned that kind of the end. Why does the order matter?
Yeah, so at different times in a company's history, they should really focus on different aspects of capital allocation. And the order that they allocate capital really matters. Some management teams have a disciplined process that they use for allocating capital, and that's a step-by-step process that they go through. Others don't, and they just do it by winging it. An analogy here that I think is appropriate is, think about the process of raising a kid. What you focus on with that kid should be highly dependent on that kid's age. If they're 3 years old, you don't want to be focused on SAT test prep. That's way too early in their life. What you really want to focus on is nutrition, the basics of language, and making sure their health is growing appropriately. This to me would be like an analogy to reinvesting in the business. When a company is young, it should focus all of its capital allocation chops on just reinvesting in the core business to make sure that it grows and is healthy. Later, when the kid is 18 years old, that's when you need to focus on more superfluous things, like perhaps how they look so they can attract a mate, or traveling, or luxuries in life, because they're already bigger and they're more established in their life. That to me is a good analogy for focusing on dividends and buybacks and perhaps acquisitions. So when you do things, so the capital allocation timing really matters. But again, this is something that is easy for companies to screw up, and it's easy for investors to screw up when they're analyzing a business. Because if you use the wrong metric or look at the wrong metric for a company at the wrong time, you're gonna get the wrong conclusion.
Yeah, that's a great point. Can you give me maybe an example or two of using the wrong metric at the wrong time of the business that may be appropriate?
Yeah, the classic one to me is the price to earnings ratio. a lot of new investors learn about the price to earnings ratio, and it is something that they apply to companies at all stages at all times. I mean, how many years would an investor look at Amazon and say the company's price to earnings ratio is 500 or 1,000, and just immediately write off the company as uninvestable? That one hits home for me because for years I thought Amazon was uninvestable because its PE ratio was in the triple digit. That to me is akin to looking at a 7-year-old and saying their SAT score sucks. Like, this kid is going nowhere in life. But if you waited for Amazon to mature and then looked at its a PE ratio, or then looked at its SAT score, then that number would be helpful. So if a company is early stage, the worst thing that you can do is look at valuation multiples, because they'll tell you the wrong thing. So as an outside investor, you need to know which part of capital allocation is management focused on before you can figure out, can we use this metric to judge how they're doing as a business?
Yeah, that's a great point. So I think when I think about capital allocation and like the order of operations, if you will, I think you touched on the stage of the company, because not all uses of capital are equal. Like, paying a dividend for a early stage business probably is not the greatest choice of allocation versus something like reinvesting in the core business, because they don't get the same kinds of returns, right?
Yeah, with reinvesting in the business, the range of returns that you can get are absolutely enormous. Sometimes you can invest in internally generated products that go nowhere and destroy value. In other cases, you can invest in internal projects and you develop the iPhone. And what's the return on investment for the development of the iPhone? I mean, is it 1,000,000%? Is it a couple of million%? So by reinvesting in the company, you can get a very high rate of return. And this should really be the number one focus for essentially all companies out there. To me, this is actually the first capital allocation choice that every CEO should ask themselves. Are there ways that I can reinvest capital back into the business and have a high likelihood of generating a return on that investment that exceeds my cost of capital? If the answer is yes to that question, the CEO should stop all capital allocation beyond that and focus solely on funding projects that create value.
Yeah, that's exactly right. So, kind of to your point, a company like Snapchat, choosing to buy back shares at their stage may not be the best choice, whereas O'Reilly choosing to reinvest in the core business may not be the best for them, kind of because they're at different stages.
Yeah, exactly. So let's go with a non-controversial company that everyone knows, SpaceX. SpaceX is a privately held company. They are investing heavily in rocket technology, right? They're trying to build up these programs to get us to Mars. We don't have a good look at SpaceX's financials, but if I was to guess, I would guess that they are not profitable right now, or perhaps just on the break-even perspective, but they are heavily in growth mode. So from a SpaceX capital allocation decision, Elon Musk should take all of the profits, all of the cash flow, all of the capital that the company has access to, and reinvest in building new rockets, upgrading their rocket technology, upgrading their ship technology, building new launch pads, right? Hiring new salespeople to bring in new customers from around the world. That should be all of Elon Musk's focus. It would be a disastrous decision for Elon Musk at the company stage to say, let's start paying a dividend, or let's start buying back stock, or let's do things to reward shareholders. That's the wrong thing to do because the company isn't consistently profitable yet. On the converse side, let's take a company like Coca-Cola. Coca-Cola does not have it's big, it's everywhere. It does not have unlimited ideas or good uses of capital to reinvest in the business. And they're generating so much cash. They're generating so much cash around the world that using all that capital to reinvest in the business would actually be a poor capital allocation decision. That's why the company is focused on paying dividends. It's focused on buying back stock. That is the correct thing for Coca-Cola, a mature company, to do.
Yeah, that's a great point. So can we talk about maybe a framework for capital allocation, like how we can think about it as investors and when we're trying to analyze a business? You mentioned, the return on investment needs to be greater than the cost of capital. Maybe can we kind of walk through some ideas of how that might work?
Yeah, sure. So to me, this is the very first question. When thinking about capital allocation, this is the very first question that every CEO should ask themselves. Are there opportunities available where I can reinvest in the business and I can estimate that my return on that investment will exceed my cost of capital? Now, cost of capital is a squishy term. It's most useful when looking at discounted cash flow models. And the cost of debt is a very known number. It's just the interest rate that you pay. The cost of equity is kind of a squishy number. Some investors use 10% or 12%, but let's just use a blanket statement that a company's cost of capital is 10%. Let's just use that as a blank number. So when a management team is allocating capital to internal projects, the only question they should ask themselves is the return on this investment above 10% per year? If the answer is yes to that question, they should fund that project. Now, they might rank their projects in order of expected return and fund the highest return ones first, but this is the number one question that they should ask themselves. As an example, let's say you are AutoZone, right? And you are asking yourself, should we open up a store in Western Montana? Let's say they don't have a store there and they're asking themselves, should they open up a store there? Well, they should do some analysis, say, what's the cost of building the store? What are the expected sales from the store? How far can we draw from? What are the expected profits? What are the expected returns on? And if they determine that opening up this new store would generate a 30% return for them, they should absolutely open that store, absolutely do that project. Conversely, if their analysis shows that opening up that store would result in a 1% return on investment for them, they should not open that store at all. They would be destroying capital because the return that they get does not exceed their 10% hurdle rate. So that very basic analysis should be the starting point for all capital allocation decisions.
Yeah. So what would I guess at what point would they decide maybe doing something like reducing debt or making their balance sheet stronger? Like if they had the choice, which like how would they decide?
Yep. So to me, the framework that I would prefer is all CEOs start with return on investment calculations of reinvesting in the business. That should be choice number one. Even if a company has debt, I still think if you can invest your capital and earn 20% or 50% or 100%, that's a better use of capital than paying off debt, because the interest rate on debt is probably 4% or 6% or 10%. So it's better to get a 30% return on your capital than to reduce an 8% interest rate. But once you exhaust your list of good, high probability, high return on investment decisions, you still might have excess capital. After that, the next question that management teams should ask ourselves is there a need for us to reduce our leverage? So the leverage I'm talking about is financial leverage. And the question there is, do we have debt? Now, there are lots of companies out there that have no debt at all, especially early stage growth companies. So for them, the answer to this question is no, we don't have any debt. But if you're a bigger company and you're paying a high interest rate, again, 6%, 8%, 10%, something like that, the answer to that question might be yes. And if the answer is yes, well, that's what you should do with excess capital. Deleverage the business, strengthen the company's balance sheet, and make the business more resilient. Dave, this is the same question that every person should ask themselves. If you have credit card debt, or if you have high interest student loan debt, and you have excess money that you don't know what to do with, you should use that money to pay off your debt. It makes you, as an individual, more financially resilient. Same thing for companies.
Okay, that makes a lot of sense. So let's say that the company exhausts their list of possible reinvestments in the business and they are paying down the debt. Let's say they have extra cash left over, like we have, an extra $100 at the end of the month in our checking account. What could they do with that?
Yep. So the third question that I think CEOs should ask themselves is profit generation sustainable? I.e., is the core business that I've created, does it produce predictable profits, or are my profits highly unpredictable or highly sensitive to an outside force like interest rates or the market conditions in general? If a company's profits are not predictable, they sell a fad product or they sell into like auto cars, which are very sensitive to interest rates, or they sell construction equipment, which is very sensitive to new housing construction. If profits are not sustainable and profit generations are not predictable, my favorite thing for them to do is build their cash cushion. I don't think they should buy back stock. I don't think they should pay a dividend. I think they should focus on strengthening the balance sheet, because if you know that your profits could disappear in the future, you need an emergency fund of sorts to get you through those hard times. So ask yourself, is profit generation sustainable? If the answer is no, just build your cash position. Now, if the answer to that question is yes, we have a predictable product, we have recurring revenue, we can easily forecast what our profits are going to be, then I think you should go on to the next question. And the next question is our stock currently trading below its intrinsic value? And you can probably guess what they should do if depending on the answer to that question.
So what should they do?
Well, so now the company can start to ask themselves, how can we return capital to shareholders? And the way that you can do that is primarily through two methods. One is a dividend, and two is buying back stock. Now, as Buffett has famously pointed out, buying back stock can be a great decision at one price and a horrible decision at another price. So the way that management teams should answer this question is checking their stock price, their current valuation, in compared to a conservative estimate of their intrinsic value. If their stock is trading at a very high valuation rate, like many companies today currently are, it is not a good use of capital to buy back your stock. You should be buying back your stock when your stock is temporarily depressed or trading well below its intrinsic value. Kind of like Facebook was back in 2022 when everyone was scared of TikTok was coming to a record. Meta buying back its stock at $100 per share, great use of capital. It's currently trading at about $750 per share. Is that the same good use of capital? The answer is probably not.
Yeah, that's a great example. And that, I guess, when you're thinking about when a company tells you in the 10K or an earnings report that they've been authorized to spend such and such to buy back their shares, and you see them doing it regularly, do you think that valuation idea is actually going on, or is it more related to they're doing it for air quote PR? It makes them look good, like they're returning capital to us, regardless of the valuation.
Yeah, all the studies that I've seen on this basically say the same things. CEOs are just as bad at timing the market as individual investors are, which is a shame because they should know their business and their intrinsic value of the business far better than any investors. But buybacks tend to surge when prices are at all times high, and they tend to plunge when you're in a bear market or it's at an all-time low. So CEOs as a whole buy high and sell low. They just do the wrong thing. This is why two questions ago we asked, is profit generation sustainable? And if the answer there is no, that's why my choice should always be to build cash. This is exactly what Warren Buffett does. Warren Buffett does not go and buy his stock at any price. He checks to make sure it's trading below his conservative estimate of fair value. And if it's not, he has no problem just letting cash build on the balance sheet to wait for the inevitable bear market that comes. So he has done this to great success. And I think right now he has a couple $100 billion in cash just sitting there. That's Warren Buffett saying, I don't have any ideas that could generate high returns on capital and the cost of capital. I don't think my stock is trading below intrinsic value. So he's happy to just strengthen his balance sheet and wait patiently. That is something that very, very few CEOs out there actually do. To your point, most of them will buy back their stock at any price simply because they think they're returning capital to shareholders, when in reality, they're just making a poor capital allocation decision.
Yeah, exactly. It's interesting because CEOs, this is obviously their most important job, but the vast majority of them, I think Buffett might have said this, they're not trained in it. They come from operations, or they come from marketing, or they come from another company and not in the same industry. And then they assume the CEO role. So it's not, I guess, that surprising that maybe a lot of them aren't good at this. What are your thoughts on that?
Yeah, I mean, so let's use Steve Jobs as an example.
Mhm.
Steve Jobs is arguably one of the best CEOs of all time, a sensational capital allocator when judged through the very first question: should we reinvest back into the core business? I would argue nobody was better at this than Steve Jobs. He used those internally generated funds to launch the iPhone, the iMac, the iPad, and a whole bunch of products that did exceptionally well. He also kept his balance sheet very, very conservative. Back when he was the CEO of Apple, they used to have tens or hundreds of billions of dollars in cash, and if memory serves, zero debt. So
Mhm.
he was extremely conservative with capital with the first two questions. He did a great job. The next two questions, he did a very poor job. He famously did not buy stock. He famously did not pay a dividend. And that would have been a great use of capital, because Apple back in the mid 2000s or even the early 2010s was generating far more cash than it knew what to do it, and its stock was trading at a reasonable valuation. So buying back stock would have been a great use of capital. This is one thing that you have to give Tim Cook full credit for, because when he took over the CEO role, he immediately started buying back huge swaths of capital, and he has actually deployed more capital into buybacks when the stock has been depressed than when it's at all-time highs. So Steve Jobs, great example of great at the first two questions, and obviously not quote unquote classically trained in financial engineering, but this is a skill set that if you're going to occupy the C-suite or the corner office, you really need to focus on.
Yeah. That's a great example, especially the dichotomies of Steve Jobs and Tim Cook and how they've approached the capital allocation. That's a great example. All right. So as investors, what should we look for? Like how can we analyze what companies are doing and what CEOs are doing?
So the first question you have to ask yourself about any potential business, or when viewing the capital allocation framework, is which stage of the business growth cycle is a company currently in? I know we've discussed this on this podcast before, but as a broad reminder, there are 6 distinct phases. There's the startup phase, there's the hypergrowth phase, there's the self-funding phase, operating leverage phase, capital return phase, and decline phase. 1, 2, 3, 4, 5, 6. If a company is in stage 1 through stage 4, the only capital allocation decision that they should be making is reinvesting in the core business. That should stop all capital allocation decisions thereafter. It's only when they get to stage 5, the capital return stage, that all of a sudden capital allocation decisions become very important, and they're generating so much capital that they have to ask themselves, should we buy back stock? Should we pay a dividend? Should we make acquisitions? Should we build cash? And that's where having a framework in place becomes really important. So as an investor, you need to ask yourself, which stage of the business growth cycle do I focus on as an investor? And how do I judge capital allocation by each stage? This is the most tricky if you're a stage 5 capital return investor, but that's probably the most common stage that people invest in. And then when you're doing that analysis, there are all kinds of numbers you should look at. You should look at the share count. Is it growing? Is it declining? You should look at the timing of buybacks. You should look at the dividend payments, and you should be looking at the returns on capital. So return on capital employed, return on invested capital, return on equity, etc. Those are the key metrics that you should look at to judge whether management team are making good capital allocation decisions or not.
What about the earlier stages? So like 1 through 4, what kinds of things could you look for in that stage or stages?
Definitely trickier, but the thing that you really need to judge management teams on in those stages is revenue and revenue growth, and also gross profit growth. So I would typically focus on revenue growth rate, especially versus the market and versus its peers, and gross profit growth. What does gross margin look like? Is gross profit growing faster or slower than revenue? What that tells you on the financial statements is, are the products and services that the company's developing and reinvesting in, are they resulting in revenue growth? And is that revenue growth at the very least generating gross profit associated with it? When you're looking at 1, 2, 3, a company is not optimized for profits, so you cannot use return on capital metrics like return on equity or return on invested capital. They simply haven't had enough time to mature yet. Once a company gets to stage 4, the operating leverage, those metrics start to shine through. But since they're lagging metrics, you really can't use them all that well yet. So I would, for 1, 2, 3, and 4, I would focus on revenue growth and gross profit growth above all.
Okay. Yeah, that makes a lot of sense. So would you look at any sort of track record for how they've made decisions, maybe comparing that to good capital allocations versus air quote financial engineering?
Yes, that is something that you should absolutely do. But again, it totally depends on the stage of a business's growth cycle that it is. The way that you should judge Tim Cook is by return on invested capital, dividend yield, and his timing of stock buybacks. That is his track record with capital allocation. And to a lesser degree, what new products is he launching and are they generating a revenue? But Apple is very clearly in the stage 5 in the mature growth phase where it's a capital allocation story. You can't say the same thing about a company like Tesla. Tesla is so heavily reinvesting in itself, and it's investing in robotaxi and the Optimus robots and the Semi and all that kind of stuff, which this can be very frustrating if you're an outside shareholder or if you're a bull or you're a bear, because you look at the returns on capital numbers and you're like, this company's profits are terrible or its returns on capital are terrible. That's simply because it's too early to judge whether a Tesla is making good capital allocation decisions by looking at those numbers. And to compound things further, Tesla's in the auto business. The auto business is cyclical. It's sensitive to interest rates. So remember that question we asked, is profit generation sustainable? For Tesla, the answer is unfortunately no, at least not yet under their current business model. So Tesla should not be focused on dividends, should not be focused on buybacks. They should be strengthening the balance sheet and reinvesting in them core selves, which is precisely what they are doing with their capital. So again, this is why it's so important to understand what phase is the business in, what is management team focused on, and how can I judge the company's progress as an outside investor.
Yeah, that's awesome. So what would be some red flags to look out for?
So the biggest red flag to me is acquisitions. This is something that is so easy for companies to screw up. And it's typically, I would say, the number one capital waster, where a management team goes out and they make some big splashy acquisitions. Studies show that big acquisitions, as a general rule, fail to live up to the initial hype of the acquisitions. Teladoc Livongo is a great case study. AOL Time Warner is a great case study. One big company merges with another big company, and the relative size of the two companies compared to each other, they almost always fail to live up to expectations. Good capital allocation from an acquisition is big company buys small company specifically to get talent or a product or a patent built into their portfolio. So Disney buying Marvel, great acquisition, great capital allocation decision. So that's one thing that you should definitely focus on. The other thing that you see lots of companies screw up from a capital allocation decision is when a company is in phase 6, it's in the decline phase. It's very common for companies in that stage to waste shareholder value by buying back stock. This is something that Bed Bath & Beyond recently did. They were very clearly to outside investors in phase 6, closing down stores, right? Revenue was going down, margins were going down. There was a huge threat to their business in the form of online shopping. And what was management doing in phase 6? Buying back stock. Horrible capital allocation decision. They should have been using that capital to pay off debt, build the cash position, and rebuild the company, reinvest in the company to make it more omni-channel focused, or protect themselves from the forces that were coming that way. It was really management's terrible capital allocation decisions that forced them into bankruptcy. So again, very common for companies in phase 6 to do. They buy back stock when they should really be reinvesting in the business.
Yeah, that's awesome. All right. So where would good capital allocation show up in the financials?
It would show up on all 3 statements. It would show up on the income statement via revenue growth, via gross profit growth, operating profit growth, net income growth and in the share count. If they're buying back stock successfully, the share count should be going down over time. Good capital allocation decision will show up on the balance sheet in the form of cash, debt, and goodwill in the form of acquisitions. And it'll show up on the cash flow statement in operating cash flow and free cash flow. And if you look down at cash flow from financing activities, it will show you how much money is the company spending on buybacks? How much money is the company spending on dividends? How is the company paying off debt, or is it issuing a new debt? And beyond the three financial statements, we both know that ratio analysis can be so useful here, right? So return on capital or return on equity, these are ratios that take one number in the numerator and another in the denominator. So this is why using tools like fiscal.ai is so helpful, because it does all this math for you. And you can just look at the results and judge, are they doing a good job or not?
Yeah, that's awesome. So what would be some good examples of things to study to learn what good or great can't talk. What would be some good companies or CEOs to study to learn what great capital allocation looks like?
So as I said at the top, go with the big popular companies that have become multi-billion-dollar organizations. The thing that all of those companies really nailed was they got their core product right. So they reinvested into themselves again and again and again and built a very popular product that is beloved around the world. The only way that you can do that is with good capital allocation decisions related to reinvesting in the core business. So all the mega caps that you can think of, they got that really right. If you want to go deeper into really how boring businesses became superb investments due to capital allocation, this is when you need to study the outliers that did not grow all that much. So O'Reilly Automotive, AutoZone is a good one. Altria Group is a good one. Coca-Cola is a good one. Pepsi is a good one. And there are lots more, but there are lots of great books on this subject that explore this. A good one is The Outsiders by Will Thorndike, where he kind of profiles, I think, 8 CEOs that got extraordinary returns for their investors. One of the things that he highlights in the book is the importance of good capital allocation frameworks and how those 8 CEOs really nailed it.
Yeah, and they really did. And that I agree, that is a fantastic book to really get a good sense of what great capital allocation looks like, because to your point, they all nailed it across the board. Brian, this has been a lot of fun. It's been very educational, and I've learned a thing or six today. So where could people find more about what you are doing online?
So if people are interested in frameworks like this, I did build a visual that kind of lays this out. I have lots of visuals on this thing. So if you want some of my most popular visuals that explain things like capital allocation or stocks versus equity, just go to stockinvesting.school and I'll email you an ebook of my most popular my most popular visuals for free.
Yeah, it's a great way to learn. I've been studying at the school of Brian for many years, and there's a lot you can learn from there. And I will include the capital allocation link as well in there, so you guys can check that out. So Brian, again, thank you very much for your time. I know I appreciate it, and everybody go check out his stuff. It's well worth it. So with that, we'll go ahead and sign us off. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.